Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Marc, welcome onto the Australian Finance Podcast today. It is wonderful to have you here.
Thank you for inviting me.
Now, you have a pretty interesting background and you've worked in the financial advice space for a long time. Are you able to give us the quick 60-second pitch for what you've done and what you're doing now?
Sure. Well, originally, going back 30-odd years ago, 1987, share market crashed back then. I was actually left an electrical engineering career, wanted to get into the share market. But once the share market crashed, I turned to superannuation, which was just starting out there. So right back in the beginning of that, and have loved that career ever since. That's 30-odd years, and pretty well what a lot of advisors do. Their clients are sort of their demographic. And so now that I was approaching retirement, my clients were approaching retirement. So probably the last 10, 15 years, I've sort of specialized in the pre-retiree market, anywhere people in their 40s, 50s, and 60s. And yeah, just loved it. Help building relationships with clients and helping them reach financial freedom. So that was great. What I am doing now is that I've decided that I wanted one last big challenge, and so decided to write a book based on what I was actually doing as a financial advisor, because I did find that unfortunately our profession is become expensive for the average mum and dad, Australian mum and dad. And so I wanted to do something a bit different. And so that started on this new career.
Yeah, and I don't think you mentioned, but you were the past president of the Association of Financial Advisors, which is pretty cool.
Yeah, it's one of the leading association bodies in our profession. And one of the good things I always loved about our profession was that older advisors would mentor the newer advisors. And I absolutely had the benefit of that. And some of the older advisors, and they just said, yeah, we're not going to charge you for this. We're going to help you as much as we can. But when it's your turn, you've got to give back. And so that was, for me, the easiest way was to help with this association and help the younger advisors and in their education and experience. And then, yeah, lucky enough to move to the national president for 4 years. So that was a fun gig, because that was actually during the Royal Commission. So that was a lot of fun times.
I can imagine. And so you've had a lot of experience working with lots of different financial advisors. And I know many of our listeners do want to get professional advice. They hear our disclaimer saying, if you want a personal question answered, go and speak to a qualified financial advisor. But often there's a bit of a gap between saying, go and see a qualified financial advisor, and actually finding the right one for you. And I'd love to unpack that a bit more, Marc. So
Sure.
Just to start with, what are some of the things that a financial advisor can even help us with?
Okay, I think it's changed. It's definitely changed from when I first started. And there was definitely far more focus on products. So there was definitely, that was the past. I really see, ever since probably the 2008 global financial crisis, was such a big hit to the share markets, but it was also to our profession. And so I think from then, we realized if we're going to help our clients through this, we do need to be actually better in our service offering. We need to be better in the values and what we can provide. And I know definitely from then, coaching became an accountability, and reaching your goals became far more important than trying to sell product. And the ones especially who are still in this industry or in this profession are nearly coaches in a way. I would never expect anyone to go see a financial advisor and they just say, okay, we're going to do this with your super, we're going to help you pay off your mortgage and, start a savings program, and that's it. Just come back in 12 months' time and that's it. It just would be, there's no relationship, there's no value there. And from a financial point of view, might actually be doing the right thing, but that's not going to cut it anymore. People do really need to be able to say, my financial advisor has helped me understand exactly what the plan is, what my goals are, and if I actually wanted to, I know enough to actually do it myself. I just don't want to. Life gets in the way. I would rather do other things. I'm glad someone in the background is looking after this. But that, to me, a financial advisor should be there as a coach, helping you understand exactly what you're going to do or what you want to do, and rather than just, oh, here's a product, invest in this, and you'll be fine.
Yeah. So if you're looking for a financial advisor nowadays, you'd really be looking for someone who's going to focus on educating you as well and helping you understand the plan, even if you don't want to put the plan into place and monitor it on a regular basis. Someone who's still going to help you understand the broad picture of how your finances are slotting into place.
I think so, because if you compared, a lot of people used to compare us to accountants and say, well, okay, why don't you just charge us a one-off fee? We see you once a year and that's it. But really, that's fine if you're looking after your taxes and it is a one-off event. When you're looking after if you're trying to reach a goal to buy your first home, or you want to build an investment property, or you want to get your super there, you want someone continually there keeping you accountable. It's always say, like, having a financial gym buddy, if it's sort of like you're on a Sunday morning, it's freezing cold and you sort of got to get up to go to the gym. If it's cold, you might just roll over. But if you know someone's there waiting for you, a coach or a gym buddy, you'll get up and do it. And it's just like I sort of compare it to New Year's resolutions. They usually, if you're left to your own devices, they probably last 2 or 3 months. But if you've got someone there checking up on you every 3 months, every 6 months, however often you want, it's the number one way to reach any goal is having someone keeping you accountable. And I think that's a great role financial advisors do, which is not usually thought of. They thought of, okay, you can invest my super or get me an insurance policy, but the accountability and coaching is not really thought of. But that's definitely a plus from all the modern advisors.
Yeah, and especially a financial advisor could potentially talk you out of making a decision that might really negatively impact your finances. Say in March 2020, you might have been really scared about seeing your superannuation balance fall, and you might have had the feeling that you wanted to change your super to all cash or something like that. And having a financial advisor or someone you could talk to, that might have been someone who would actually talk you out of making a decision that could be quite harmful long term.
Yeah, and I think it's like in anything you do, you're just busy in life. So if you just quickly see a snippet or a headline and see everything's crashing around you, well, of course you're going to, it's human nature to want to react and do something to fix it. You don't want to just sort of hold, sit on your hands. And unfortunately, sometimes that is the actual best advice, is to, okay, historically, we've always had these about once every 10 years. And the best part, because no one can time a market or pick a market, it's been pretty well proven. And so you've just got to ride this out. And historically, we know it will always rebound. We just don't know when and how quickly. But, people, I have spoken to many people who have said, oh, okay, no, you only need to wait 6 months or 12 months and then the share market will there. So as long as I keep it in cash and I've seen share markets in 2020, for example, that was 3 months. No one picked that was going to come back. And it's like 60, 70% of the rise was on one day. Mm. So you can't pick it. It really is too hard. And so I think it's just a matter of getting advice to sort of sometimes do nothing is the best advice at all.
Yeah. And I feel like we often, when we pay for something, we want something actionable right then and there, and we want to get something for it. So getting told just your finances are great, like leave them as they is often hard to sort of justify that price in your mind, isn't it?
Yeah, it is. But having at least someone who is there to tell you that is important. And I think in the past, that's where I think financial advisors, especially, as I said, the 2008 global financial crisis, we had probably 10 odd years of really, really good returns, and a lot of new advisors to the industry had never seen a negative return. So when it happened, they didn't know what to do. And unfortunately, I think a lot have found out, well, we're hiding because we don't want to have all this unhappy client. Whereas it's actually, we now know in anything in life, bad news, you've got to be on the front foot. You've got to actually try and help people understand and help them through this. And I think the modern advisor is well equipped to do that.
Yeah. So you want an advisor who's going to be able to have those conversations with you as well.
Yeah. Yeah. And I think there was a really good little quote. I used to use it about having someone helping busy people make smart decisions about money. And I think it just really is, because exactly what you said before. There's so many times you listen. There's so much information out there. That's the simple thing, whether it's Google or it's your best friend or someone's heard a tip or something, you got to do this. And it's just unfortunate to sift through all that information. That's why, you go to a doctor, you hear all this knowledge or hear all this information, but, your doctor has the knowledge to sift through that. And that's what a financial advisor does. And can absolutely, over a period of lifetime, can save you thousands, absolutely, from not making bad decisions or not reacting when you should just leave things as they are.
Now, I know there isn't a specific figure here because it really depends on who it is, but what is the cost of financial advice like nowadays?
Yeah, it does vary. And so it really is important to sort of, depending on your circumstances, and we were saying before about the disclaimer, because if you want something tailored to your own situation, everyone is different. So that's the first thing. It will vary, but if you wanted to give a ballpark, and I actually have a whole chapter in the back of my book to actually talk about exactly that, how to find an advisor, what the standard costings would be. But if I was staying somewhere between 3,000 to 5,000 for the first year, yes, it could go up to 10,000 if it's quite a complex situation. But 3,000 to 5,000, because there was a survey done recently where people said they're willing to pay $500 because I just want a simple savings program. That's fine, but unfortunately, the compliance and regime that financial advisors have to do, and we get independently audited every year on the advice we give, there's a sort of know your client rule. So even if you came in and said, I just want to help me set up a savings program, well, we need to ask all the questions. I should say now, in the past, I used to ask all the questions just to ensure you're not in $20,000 debt. There's no use starting a savings plan if you're heaps of credit card debt. So there is a reason for it, but that can take finding out about your situation, then doing the research on whatever super or insurance or whatever you might have, so that they actually have a full comprehensive picture of your situation, and then doing a report can take up to 20 hours. So it can't do it for $500. So that's the reality. And so for people who are thinking, that's all I need, my suggestion is, if you really aren't feeling, okay, that's not my situation, and I do understand it is expensive, there's wonderful things that you can actually, or you can read, you can listen to podcasts like yourself, which can actually give you the basics. And once you've actually, which for me is getting your cash flow right, and getting your savings right. And once you've started saving and you've started to build a little bit of a nest egg, then I think it's worthwhile to do that, because it is worthwhile, even if you did go just to see if I just want to get the very basics right and go once, get your cash flow, get your debt, get your super, get your insurance, and all those little things right just once. You could do that, and then maybe in 2 years' time, you come back to actually build a plan that's going to be an ongoing service relationship.
I know some listeners who are a bit further into their journey have used a financial advisor, like they've done all the research, they've put their plan into place themselves, and they've used a financial advisor just to check they haven't missed anything on their journey, because they wanted to make sure they hadn't missed setting up their insurances or check that they were in the right super. And so using a financial advisor more of a sounding board, which is quite a cool idea.
Absolutely. And there's definitely financial advisors who will do that, one-offs and just charge you an hourly rate. Probably comes back to, that's still for me from my research and my experience, that's probably a very small minority of people who are that self-motivated who can do that. And funny enough, accountants and engineers are the two professions that seem to be, we like doing the numbers, we really enjoy doing this, and we're actually self-motivated to do it ourselves. The rest of us just seem to be, life just gets in the way. So yes, I will come back and see an advisor next year, but 5 years pass, and that's the problem. So it's like anything. Yeah, we have our savings goals and like that, but unless we have someone that we definitely have a finite, I've got an appointment in 12 months' time. If it's just left up to us to remember, mortgages, kids, everything gets in the way. So that's my experience anyway.
Yeah. And given that it is costing $3,000 to $5,000 potentially for that first year of getting some advice, when does it make sense, like in terms of maybe net worth, to actually see a financial advisor? Because if you've only got $5,000, most financial advisors would probably say it's not worth coming to us for financial advice because that would use all of your money. You'd have nothing to actually invest or do things with. So when is there a salary or is there a net worth where it would actually start making a bit more sense to see a financial advisor?
Yeah, yes, there is, but and as I said, every person's different.
Yeah.
But if I was thinking that, and especially when I was seeing clients, especially in their 30s and 40s, it was usually, you can usually get your first deposit for your home or investment. If you're going to rent invest for your first investment property, you could probably, people do that on their own. And they've got a real goal in mind. So they've got a clear, and there's a motivation there. I want to get out, stop renting, or I want to leave home. And so I want to be able to most people get to that point. Once they probably have that home and maybe starting a family, that's probably 1 or 2 years into a home because, firstly, you've got an asset that's worth protecting. And there's, even though you might have a pretty high mortgage against the actual asset, within a couple of years that will grow and that mortgage will start coming down. So you're going to have a net worth there as well as what your savings are. And if you've had super probably for 10 so years, that's building into quite a sizable asset too. And what people probably don't realize, because I used to actually do a lot of talks around corporate superannuations, to companies and their staff. I absolutely get, if you're in your 20s, 30s, and 40s, you think, well, super's somewhere in the future. I'm never going to see this, or it's going to be forever. But having it invested correctly rather than just sitting in the basic default fund can be an extra 2 or 3%, and over a 20, 30-year period will double your superannuation. So getting a lot of that even done right, and as well having the safety net of insurance. So pretty well, once I would probably have a property, once I've started a family, therefore I'm responsible for dependents, and I want to make sure if something ever happened to me, they're going to be well looked after. And thirdly, your superannuation's built up. Probably, and also you probably need a will, once you've got an asset and a family. So they're the sort of things I would be thinking, okay, that's worthwhile just going there. And whether you actually stay with that advisor or not, but getting an initial plan would be worthwhile.
Okay. Yeah. Because I know I saw a question from a listener the other day and they said, I've been on really low incomes all my life and now suddenly I'm earning hundreds of thousands of dollars. So I don't have a huge nest egg or anything because I've never had money to put aside, but suddenly I'm actually having a lot of income and I'm not really sure what to do with it. Would that also be a circumstance where it might be worthwhile seeing a financial advisor?
Yeah, and I'd actually have two parts to that question, if you don't mind. The first one is absolutely, your salary goes up, you've never had this much money in your life and you don't want to blow it, and I totally understand that. So yes, there's plenty of advisors who specialize in millennials and getting your savings right. So not actually waiting till you have your first home and all that. And they're absolutely brilliant too. So I've got no qualms that, if that's your personality as well and you're happy with that, that would suit you. So definitely, you've got this, you've got to make some decisions. So see it financial advisors because you can actually get your savings ramped up, getting your money working harder for you to buy your first home and all that. So I totally understand. So that's definitely appropriate. The second part to that, I would just say from my long experience in doing this, there is so many people who have always said, once I get my next salary increase, that's when I'll start saving. Once I get the huge pay rise and I'll have all this money, that's when I'll be able to get my financial act together. To me, that's never worked out. It's because usually, in reality, you get that higher salary, so does your lifestyle expenses. You want to enjoy life, and I understand that too. So I've seen people who are on $50,000 a year, into their 50s and 60s and have 5 properties. I've seen people who are on $1 million a year and are mortgaged up to their hilt, and really just one interest rate hike and they can lose everything. So it's not so much the money, it's more what you do with it that's really important.
Yeah, that's a really good thing to keep in mind. And if someone's listening right now and they've maybe done a bit of research, asked for some recommendations, they've got one of those free intro calls booked with a financial advisor, what are some questions that you would ask in that very first meeting with a financial advisor to figure out if they're the right fit for you and what you're planning to do?
Okay, I think there are a few questions, but if it's a really good advisor, they'll be asking you the questions. It's really, because I think it works both ways. You want to make sure you're a good fit with that financial advisor, but I think it's the other way around. A financial advisor will want to feel like I can actually help you as well. He shouldn't just take you on as a client just because you're knocked on the door. So I think it does work both ways. But I think, and they should be wanting to ask questions to actually, what are your goals? Not just, what's your super, what's your cash balance? What are your actual goals? What are you, and how they can, and then they can look at how they can help you. But if I was asking a meeting for the first time, I don't want to know their credentials. You just have to, most advisors are either have a degree or a degree equivalent. And so that's important. I actually personally, and not being biased, but I do think whether you're part of the the advisors part of the AFA or the FPA, the two big bodies, is important because I know they've got an association backing them. And the third thing is, tell me about your type of clients, because you will find advisors who specialize in pre-retirees. There'll be ones who specialize in millennials or people who are accumulators. And you will know exactly from your own situation what you want this advisor for. So it's really important to make sure that what that advisor specializes in, and a lot of advisors are, especially, they don't sort of, I would, if I'm looking after pre-retirees, because this is roughly my age, I wouldn't be looking after millennials. They look at me and just wouldn't fit. I totally get that, so
slightly different goals.
And that's really important. That, just for someone to actually, you want your advisor to say, I get you. I understand totally what you're doing, because I've either been through that or I'm going through that myself. And just from a financial point of view, I can help you with those. So I think, meeting 2 or 3 is also worthwhile, but actually making sure that what that advisor provides, or what the typical type of client they look after, is you. And you will find that. And usually, actually, the way I usually do find in anything in life is that I do ask my friends and see, do you have someone that you're really happy with? And I'd like to go see them as well. And so a word of mouth is still great in this profession.
Yeah, I think that's a really good thing to remember, that you can actually have multiple intro meetings. So you can actually meet with a few different advisors and try and work out who's the right fit for you, because you want someone that you leave the room feeling like you were empowered to ask questions. You didn't feel like you were being belittled or looked down upon. You want someone who's going to empower you to take control of your finances over a long time.
Yeah, and I do know, and it's definitely part of my role when I was with the AFA, was to mentor and talk to a lot of advisors, especially new advisors. And if you're in a profession, it doesn't matter what profession you're in, it's sometimes you can fall into the trap of using jargon. And it's sometimes, there's so many acronyms in our industry, and even say, the GFC, and someone said, well, what was the GFC? Okay, for us, the global financial crisis was a huge deal. So people would just say GFC. Well, no, why should I assume that person knows what the GFC is? But unfortunately, some advisors do fall into that trap. So I think that's when, just chatting to the advisor, seeing if there's a comfort level. But if they're trying to say, for a start, as I said, they should be asking about you, what your goals, so they can help. If they start just rambling on about, I can do this, I can do that, and start using a lot of technical jargon, they're missing the point. That's talking about them rather than focusing on you. So I'd really look out for that. And really, the last is really cost. It's yes, you could always find someone cheaper, but will they actually do a good job for you? And it's the good thing about our profession, the way it's set up, is that they charge you a fee, can only last a year. So pretty well next year, you have to sign a document. I think it's still called an annual fee disclosure statement, to say that, here are all the services you've been provided. You're happy with it, and you're happy to continue on for another 12 months. And it can always be stopped at any time. So that's the good thing that's also changed now in our profession, is it's not, you're paying for a fee, and 5 years later, oh, I've never heard from that person again. This is still being deducted. That can't happen because it's all fees are usually deducted directly from the person, not through a product.
Okay, so you're not stuck on a recurring Netflix style subscription that you just
That's
forget
right.
to cancel.
Yeah.
So you actually know what you're paying every year. I think that's probably a very good improvement, isn't it?
I totally agree. Totally agree. So I should say life insurance is the only one that still has a percentage commission. And some people say, oh, it shouldn't have commission or should have commission, but it's definitely, it's different. Like if you're paying a fee for your superannuation, that's fine. But if you're having a commission, the last thing you want to do is if you're having to claim on your life insurance or your family's got a claim, you say, oh, well, you've got to pay me a fee for that. No, that's what commission is there for, to help you in those. So it's a bit different as a product, but from definitely investment, shares, super, you should be paying a fee, and you should be signing off on that basically every year.
Awesome. Now, if we turn away from the topic of advice, which is really important, but I know you have a lot of thoughts on the topic of the upcoming sort of intergenerational wealth transfer. I've seen many articles talking about that there's going to be this massive transfer of wealth from older Australians and just people globally to younger Australians. And sometimes it hits either side. So it might be young people or also people getting it from their parents or their grandparents. So I was wondering if you were able to sort of explain a little bit more about your thoughts on this, and maybe how do you prepare yourself or prepare your children if you do expect you might be receiving a sum of money?
Yeah, and thank you for asking, because it really is a good point to talk about, because people, first of all, people don't talk about it. That's the problem. We're Australians. We have probably a lot of English background. And so English don't talk about money. Whereas if you came from America, they would just talk about it openly. What's your salary? How much you're worth? What are you doing with it? And it's really, sometimes for Australians, it's very confronting if you're in America and they're around a dinner table and they're asking you all these money questions. We just don't talk about it. So it is something I really want people to talk about, but yeah, not in a bad way, but it's just, we do need to be far more positive about money. And I think when I ever talk to my clients and say they were pre-retirees, 50s and 60s in the main, and I may ask them, what are your 3 goals? Typically, yes, the first one is I want to be able to retire comfortably. I want financial freedom, financial independence, and stop working. Totally got that. But usually the second goal is I am really worried about my adult children, or I'm worried about my elderly parents. To the point that's sort of nicknamed the conversation, to have this, to have about the wealth transfer, because firstly, baby boomers and this generation below 50s and 60s, just before the Gen Xers, they have built up a significant wealth, whether it's super, whether it's property, their own home. We're only seeing in the major cities what a standard home's worth now. We're talking millions. And so they're worried that transferring to their children, they're going to get this huge lump sum of money. Will they be financially equipped to handle it? The second thing is, and it is a pet peeve of mine, is that for especially now on TV, every second ad seems to be a gambling ad. So, my generation, it was the smoking. And we've pretty well seen that stopping tobacco advertising pretty well killed smoking for 90% of it. And I'm really hoping something eventually happens to the gambling and easy debt, easy loans. Oh, I don't have money this week. Go get this pay loan. It'll just quickly do that. And that just starts this endless cycle. So there's sort of some crazy data around that, from easy loans or pay now, buy now, pay later, or credit cards. The average 25-year-old is nearly in $5,000 debt already. And so, that's the sort of things that keeps their parents or their mothers up at night, worrying about that. So I think, yes, that wealth transfer, but also that there's so much easy access to debt nowadays that there's a real concern around that. So I think, yes, there's far more knowledge and information and helpful services around finance and money now, but it is, that generation do worry about that. So looking at the wealth transfer itself, what I think we talk about it is that we actually say, having the conversation. So for your adult children, just say, sit them down, have a dinner and just say, I just want to go through this. I just want to go through, here's our financial position. This is what we're saying in our will. If anything happens to us, this is what I really want. Do you have any questions? We never need to talk about this again. It's that sort of thing, but at least have it once. And your kids say, we don't want to talk about this. You're going to live forever. We don't want to. I totally understand that. Well, hopefully that's what they're saying.
Yes. They're not just counting down the days.
Counting down the days. This is my inheritance. But I do think it's at least important to broach it. And it's on the flip side, elderly parents who really, that generation, the war generation and all those sort of, they don't like talking about it. So it's even harder with that. But I think that's important to talk about that from that side of it as well.
Yeah, I remember even just at a previous job, there was some clients where the husband had been running the finances for a long time and doing all the investments. And the widow was calling afterwards and saying, I don't know where any of the money is. I don't know where the investments are. I don't even know what things are invested in. And I always thought that was horrible that this person was sort of just kept in the dark. Sure, it was normalized back then, but they didn't know where their money was or where it was invested. And I think that's important to have those conversations like openly with your kids or your parents, things like that, just to make sure, even though you're not talking about the specifics, you're not saying, I've got $100,000 in this account, but just sort of a general awareness of how you're investing and what sort of products you're using even.
Yeah, and it's probably my number one tip for people when they're talking about estate planning or even just getting a will is actually to have two things, list all the important people in your life and also have a list of where all your important documents are and what they are. You don't have to put PIN numbers or anything like that. That's, you don't for security, but having those sort of things, exactly that. I have seen way too many situations where widows just were totally in the dark and just did not know. And unfortunately, it's just you're paying a solicitor to go try and find these things when actually sometimes you just go and search through drawers and all these other things to try and find these documents. So it's terrible at that stage when someone's just lost a loved one to be put under this financial strain of, well, will I lose the house? Will I actually even be able to pay for dinner because I never looked after that or never looked at? So I think absolutely you're right. This generation far more. There shouldn't be any excuse for why male or female is not learning both. But I still even find in most relationships, one will still prefer to do it than the other. So it's not that you shouldn't both know, but one will prefer. So that's fine as long as you both understand it.
Yeah. And I think even if one person in a relationship, I know many people where one just doesn't really care or doesn't want to deal with the finances, but even just keeping them sort of aware of what's going on. Okay, I'm investing this money here. I know you don't want to know the fine details, but I'm going to just tell you the overall picture and here's how you can log in and things like that, just so they're aware if anything does happen, they know how to access it, which I think is really important.
Great.
And if you do expect that maybe you've got adult children or teenagers that might be receiving money from you or your parents down the track, what are some things you can do to prepare kids to receive a sum of money?
Okay, I think the first thing is teaching them some savings, some cash flow, because you learn pretty quickly if you're in your own business or anything like that. Cash flow is king, and it's so important. And it's not so much getting into a tight budget or anything like that, or because most people think negative connotations around a budget, but understanding where your cash is going, because from my generation we were paid weekly. Very rare to find anyone paid weekly. They're either paid fortnightly or more typically monthly now. And what I see is that if you're getting paid your salary once a month, first week or two is great. Third week's a bit tough. And fourth week, there's either no money or unfortunately maybe going into debt to sort of get to that next pay period. So getting an understanding of firstly, how that cash flow is going, and secondly, where it's going so that you feel in control, because most people say, where did that money go all month? I've made this amount of money in the last 6 months. Where did it all go? Mm-hmm. So keeping a bit of a track of, and what's great is pretty well every bank does it for you. It's automatic. You can track all the different type of things, and just having a look and saying, okay, this is how much, as you said before, Netflix and all your subscriptions. This is how much Uber Eats I get, and all that. That's fine if you want to spend it, and you just say, don't have any money at the end of the month, but at least you know. That's absolutely the number one tip for people on, for me, is to get, once you get that cash flow, and it is actually a tip that I actually do like to say is, one is I actually say, if you do get paid monthly, the easiest way is to last a week. And so have a separate bank account that from your main bank account, you just pay yourself a weekly salary once a week, and just automatic. And then you don't touch the main bank account where the monthly salary goes in and expenses come out, but you have your tap and go weekly salary. And if you blow it in 4 or 6 days, you know you only got to last 2 days till your next one is. And I think that's a great habit, because it was always people who get paid weekly found it far easier with cash flow and budgeting than present with the whole month thing now.
Yeah, it's quite hard when you're looking, you've suddenly got your couple of grand in your bank account for the month, and then you're kind of, it looks like a lot at the time, but then the time you get to date 25, 26 of the month, you're going, it's kind of run out.
Yeah, exactly right. The second thing is good debt versus bad debt. It's to me, once you get your cash flow right, it's part of that is understanding how much you're paying for credit cards and all that, and getting them under control. You know, credit cards, you should never have more debt from a buy now, pay later, or a credit card or a loan that you can't pay back in 10 months based on your savings capability. So for example, you can save $200 or $300 a month. Therefore, you should never be able to borrow more than $2,000 or $3,000, because you should be able to pay that. Doesn't matter what the credit card says you need to pay back as a minimum, because that will take you 20 years. You want to be able to pay it back in 10 months. So roughly thinking, whatever the amount you loan, if you pay it back in 10 months, it's going to be very little interest. So you can just do a simple divide by 10 situation. So that is when it's a bad debt. But I also like to say, Robert Kiyosaki wrote Rich Dad, Poor Dad. And while it's a book of just basically stories, and whether you believe it or not, he really does do a lot on good debt versus bad debt, because it's what the rich really have been teaching their kids how to use leverage and using good debt to buy properties and shares that will just grow over time, or having people renting them will help pay off the loan, against bad debt, which is, I'm going to just use all my money to buy the biggest TV or whatever it is, when really, so understanding that good debt versus bad debt, and there's plenty of stuff on the internet to explain how they go into a lot more detail. But yeah, getting your cash flow right, understanding good debt versus bad debt, and then the third is getting your super right. Superannuation, something that people just don't bother about. 80% of Australians are sitting in the default, and it's usually the default balanced or life stages fund. And if they actually just did a little bit of research and looked at, and when I actually look at the returns over, say, of a superannuation fund, I always look 10 years, at least 7 to 10 years, because that's a good indication. 1 or 2 years is too hard, because the share markets go up and down, but 10 years is good. And a balanced fund may have returned on average for most super funds around 9 or 10% on average. Yes, there's been 1 or 2 bad years, but on average 10%. A growth or high growth fund has earned 13% in most funds. So you should look at that. So that's just having more shares in your superannuation by choosing that. But once you choose that better fund, and I said this is not advice, everyone should check it out, but it's just, if you just look at history, if you can get an extra 2 or 3% on average better return over a 30-year period, your super fund will triple what it would normally have been. And just forget about it. You don't need to touch it again. I know I say, put more contributions in, add more contributions. No, just get it invested right and get it working harder for you. They're probably my 3 tips. And I always say, get a safety net of insurance, but that's usually when you're having children and you've got debt. It's probably the 4th one.
Did you ever have any examples of clients that had actually sat their kids down and gone, okay, right, maybe their kid's like 25 here, but right, we're going to sort your super out today. We're going to compare some options and actually get you set up, because if I help you with this one thing, that's going to pay off over decades to come.
Absolutely. Even if they don't sit down, because they may not understand it, there's plenty of information about on those sort of things. Like, I've got my website, there's an article, and there's plenty of articles out there that actually explain why investing in the share market or in your super, which just means having a higher growth type fund, is worthwhile as long as you're talking long term. 1 or 2 years, especially as right at the moment, we're in a down of the share market, but and we were slightly down in 2020, but it was 2008 was the last time we had a really big negative share market drop. So on average, you're way ahead if you're getting that. So I think, yes, parents can really help that, but you can just definitely, for your listener, they can help themselves just a little bit. They just go to their own super fund. It's not talking about which super fund's best or product. It's just look at your own super fund, look at the choices, and there'll be, say, 5 investment choices, and you'll probably find you're in the middle one. And it's Goldilocks isn't appropriate in this situation. It's not just it's not too hot, not too cold. I'm happy in that middle syndrome. No, you want the one working hardest for you, and over a 10-year average, which is performing best, because based on history, that's what we're going to base all our future investments on, even though it's no guarantee. But it's historically, I can do 10 years, I can go 100 years, and I can see that the Australian share market has always been the best performing situation. So yeah, it's worth that. Parents can sit down there and just go through these 4 different topics. But there's plenty of information out there that if they want to say, well, if you don't want to listen to me, go listen to this podcast, go listen to that, and you'll learn about it for yourself. Because if they get a healthy comfort for money, it'll be a lifelong benefit to them.
Yeah, absolutely. Marc, we've covered a lot of ground in today's episode and lots of strategies for listeners who are interested in getting advice and just understanding a bit more about how the whole process works. Before we wrap up today's conversation, is there anything else you wanted to share with my listeners?
Yeah, I wouldn't mind. There's a couple of tips I really love talking about whenever I do this. And the first one was because we're talking about the cash flow. One of the things is, even if you don't do the weekly salary, the number one tip I've always done to help people save is to pay yourself first. It's just a standard old age, true and tried tip, and it just works. And so that, because people will say, okay, whatever I have left over at the end of the fortnight or end of the month is what I'll save. And typically there's nothing ever left by the end of the month. So you make yourself your first creditor. So your first bill, usually the day after you get your salary, transfer whatever, it's a small amount. Just start off with something small that you're not going to worry about going into another separate bank account that you won't touch. And at least then, if by the end of the month you don't have anything, you've done your savings for the month because you were the first. So pay yourself first. The second one is something I'm getting really a lot into in this financial wellness zone. And I know that a lot of the banks are talking about financial wellness, but really, to me, it boils down to be that work-life balance and being happy and positive makes such a difference. And I find a lot of people say, we were talking before about when I get my next pay rise or when I move to this bigger home, that's when, I'll be financially successful or whatever. But usually also, that's when I get my new job. That's when I'll be happy. Now, you need to be happy now and positive now. That will help you get your next salary increase. That will help you get your next job. Or even if it doesn't, you'll still be happy. But too many people think of that next pay rise, that next job, that next situation. That's when I'll be happy. Where to me, it's the wrong way around. So financial wellness to me it's not just about financially being comfortable. It's also being happy and healthy as well.
I love that, Marc. And if people want to learn a bit more about you and your brand new book, The Money Sandwich, where should they go?
Well, they can go to any bookstore. It's pretty well anywhere around Australia and New Zealand. You can buy it online, Booktopia and Amazon. It's there. And they can also head to the moneysandwich.com website. There's lots of free articles, free calculators. I built this so sort of people who maybe that intermediate step before getting financial advice just don't want to pay a lot, or they may not be able to afford. Everything on my website's free, basically, apart from saying to buy the book or this new online course, but lots of resources, lots of calculators, and so it's all there free.
Yeah, and it's a good resource for any older listeners who are looking for something that might be a bit more suitable to them, and maybe talking from someone who's experienced what they're going through, because I know Owen and I are on the younger side in our 20s and 30s. So sometimes it's good to actually hear from someone in your own generation as well, who might have a different perspective on things.
Yeah, and hopefully many of your viewers may be looking for a Father's Day or Christmas present for their parents. So it'd be a perfect present, the book for them as well.
Yeah, wonderful. Well, Marc, thank you so much for coming on the show today and sharing some of your tips and lessons and experiences as a financial advisor and from your research for the book with my listeners today.
Thank you, Kate. Much appreciated.